So this talk is going to cover the new CGT regime for non-residents holding UK residential property, the interaction of the new CGT regime with ATED-related CGT, because of course one has to think about that, Section 13 TCGA and the motive defence, and a look at the benefits or disadvantages attached to using various offshore structures under this new regime that we've got, covering all the various taxes that deal with residential property. Now, the next thing that we need to think about, having thought about ATED, is really its rather annoying little cousin, brother, whatever you want to call it, which is ATED-related CGT. Now it applies only in circumstances where ATED itself applies. So if you are within an exemption to ATED, or you're not within ATED at all, then you don't have to worry about ATED-related CGT. It applies to relevant high-value disposals, meaning disposals on the whole or part of an interest in land which has at some time been within the charge to ATED. And the normal CGT sorts of rules apply in determining the date of the disposal and the amount or value of the consideration for the disposal. So, Marika, are there any reliefs that are available to people?
Thank you, Aparna. There are a number of reliefs. They are listed on the slide that you should all be looking at now. They're only mentioned here for completeness and also to draw a distinction between the reliefs that exist for these three charges that came about in Finance Act 2012 and 2013, being the higher SDLT charge, the ATED and the ATED-related capital gains tax charge. This is in contrast to the reliefs that do or don't apply to the capital gains tax on non-residents. I'd like to particularly draw attention to let property, which does benefit from reliefs from ATED, ATED-related gains, and the SDLT acquisition cost. And that, for example, is not the same under the new regime. I don't want to talk any more about them. The conditions for the availability of the reliefs are quite stringent. In addition to the reliefs that I mentioned on the slide, there are exemptions for charitable bodies, public bodies, and dwellings which are conditionally exempt for IHT purposes. There are a lot of them. The technical guidance provided by the Revenue is long, and frankly, I long for a much simpler tax system. That's all I'm going to say about the reliefs. Aparna, what was the reason that was given for not getting rid of the ATED? Or what is your insight to...
Well, the stated reason at some of these meetings was that the rationale for the introduction of ATED was that they wanted to penalise enveloping. So therefore they wanted it to be at a higher rate of tax. The new NRCGT regime was going to be taxed at a lower rate. They were going to tax it at 20%, and therefore they wanted to keep ATED-related CGT in order to catch people at 28%. They couldn't do anything that might distinguish between UK, non-UK owners or EU and non-EU owners because of clearly EU discrimination issues. Yes. Exactly. So they couldn't do that. But that was principally the reason they gave. They also said that because the policy rationale for it was different, the NRCGT regime being implemented because they wanted to create fairness as between non-residents and UK residents, and for ATED, it being a punitive measure, they didn't see that they actually overlapped in any way. But of course, the fact is that a single disposal can give rise to multiple tax charges on different slabs of the gain. So you're going to have quite a complicated computation.
And of course, trying to discourage a behaviour like enveloping might result in discouraging a behaviour like investing in the UK.
Well, there is
if the rules are too complicated.
Exactly that. So what we've got next is a sort of discussion area, which is to look at commonly one used to have an individual who had created a non-resident settlement, which then held shares in a non-resident company, which then held underlying UK residential property. That was a typical offshore holding structure. Now, set out in this table, and perhaps Marika will speak to it, is the considerations one would have to take into account pre the introduction of FA 2015 and the new NRCGT regime, if you were thinking of winding that structure up.
And before I talk to the slide, I'd just like to say that at this point we are discussing structures. So if any of you have any questions, this is the point to try and work them in, because this is where we draw all of the slides and all of the talk together. So the considerations, it was really a lot more straightforward in some ways before the NRCGT, inheritance tax was the main reason to remain in a company, because the value of the shares in a company were outside the scope of UKIHT if the individual was not domiciled, or if they were held by an excluded property trust. That's a 40% saving on often some quite substantial properties, so it was a no-brainer for a lot of people, particularly when the ATED charge wasn't that expensive. So on the do-nothing side, you had your value of the shares remaining outside the scope of UKIHT. You were potentially subject to ATED-related CGT on a disposal. The ATED charge was a nuisance, but it was probably affordable compared to the inheritance tax charge. That might depend on the profile of the age profile of the person who would ultimately have to pay.
And indeed asset holdings.
And the asset holdings, indeed, but also ability to fund it, all sorts of issues about how to fund the charge in the circumstances. SDLT, on the other hand, it was preferable in certain circumstances to keep it in the company because it was cheaper for a purchaser to buy the shares in the company. So that's where we were, and on the next slide we talk about where we are now, and also where we soon will be following the next changes to inheritance tax, which is that if you do nothing and you remain in your envelope, the value of the shares in the company will soon no longer be outside the scope of inheritance tax. So that becomes a tax neutral consideration, and in addition to that, the ATED charge has become a lot more expensive than previously. So it seems to me, and Aparna, I don't know if you agree, that the incentive to de-envelope has now increased. Or will, as of 2017, increase because you lose the inheritance tax advantage.
I think that's got to be right. Assuming that the announcements that were made are actually implemented and put into FB 2017, then from that point onwards it's going to become a much more debatable benefit, because you don't have IHT protection, so all the other costs are live costs that you then have to fund in some way. So what is the optimum regime? Well, it depends, I think, very much on circumstances. If IHT becomes as neutral as the FB changes suggest, then obviously it becomes something that you don't have to think about. But there are many other considerations too, and benefits attendant on holding trusts. I mean, there's asset protection from creditors and the like. So it's worthwhile thinking about and taking advice on the appropriate structure for the future.